Welcome back to Squawk Box. Rick Santelli with very important breaking news. Our May read on Consumer Price Index. Headline number up 0.6, a little hotter than expected. And if you strip out the all-important food and energy, up 0.7. That's also more than expected. But, and this but's important, I don't see the revisions yet, but until I do, this follows numbers that were even higher last month. All right, here's the Moneyball numbers. Year over year, with the base effect in effect, and that number is up 5% on CPI year-over-year headline. How does 5% stack up? The last time we had a number that was higher than 5%, was August of 2008. Strip out the all-important food and energy year-over-year, up 3.8. Last time we had a number higher than 3.8 was January of 1992. Now let's go over initial jobless claims. 376,000. And of course, this is a very good number because once again, we are now looking at post-COVID lows. And granted, it's not by very much. The previous record was, well, last week at 385, which still could be revised. And if we look at continuing claims, finally, I get to say on live TV that we made a lower number on continuing claims, post-COVID low, because the last couple of times we did that, it was on a revision. Wasn't actually on the week we were talking about. 3.499 million, whisker under 3.5 million. And, of course, the previous record was 3.602 from the second week in May. So these are very much numbers that are good for the economy. We know that we could see more hiring, less claims, but there are some sticking points to the reopening. I think the inflation data is very important, but if you notice, interest rates have hardly ticked up. We're at 151 on a 10. We're at 219 on a 30. And I think the base effect is really what traders are paying attention to, which means that the year-over-year comps are a bit distorted by ultra-low rates during the worst part of COVID, and they're starting to take the side of the Fed. It all sounds great to me. But if the Fed isn't correct and the ultimate notion isn't transient, boy, you could see a big move. But for the moment, especially with yesterday's robust 10-year note auction, I totally think that you're not seeing the short presence looking for higher rates in treasuries or any global sovereign that you were just 4 to 6 weeks ago. Andrew, back to you.
Thank you, sir. I'm going to pass it over to Steve Leisman because we want to get his take on all of this. Steve?
Yeah, so let me talk about inflation real quickly. Is Rick still there? Rick has some used cars, and that's understating what Rick has, because Rick has some awesome classic cars. Man, they're going up in value, Rick. Good investment, because automobiles, used cars and trucks up 7.3% on the month of May, after 10% in the prior month. Rick, what do you have? Some old Fords, as I understand it?
Oh, we have a lot of old ones, but the one I've been working on the most, if you could see my fingernails, as a matter of fact, till midnight last night, an old Kennedy-era Lincoln, suicide doors, 67 Continental. And I'll tell you what, it's funny you mention that, because it's not only inflation on car prices, used prices, it's also collectibles, it's also lithos, it's also art. What do they all have in common? They're not paper. They're not paper. You could touch them, you could sell them, you could look at them, you could drive them, and that's important.
But let's talk about what's going on, Rick, and I don't want to take it from our fabulous anchors here, but isn't the market trading like this is peak inflation? You look at the forward rate of implied inflation in the tip spreads. You look at what's happening with the 10-year. You look at what's happening in the markets. And with gold, it looks like the market has sort of taken on, I think you said it, has taken on the Fed's case. I don't see fear of inflation in the markets. I think people are concerned. I think when you see home prices going up, food prices going up, all this stuff going up, there's a lot of palpable concern among individual and average Americans. But to look at the markets, it's like, hey, been there, done that on these 5% inflation numbers.
I couldn't agree with you more. The market and traders have definitely decided that the Fed has unlimited firing power. They're still using their bazooka, even though pretty much the COVID war is over, and they're going to quit kicking the tires. But, see, as much as I agree with you, that doesn't mean the Fed's correct, doesn't mean investors are correct. What it means is you go broke trying to challenge the Fed. Ultimately, we're going to see where inflation pans out. Ultimately, we're going to see which policies are going to come back to haunt us. But for the moment, I would think that today's 30-year bond auction might find a raft of aggressive buyers.
Shepard Smith here. Thanks for watching CNBC on YouTube.